Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week's episode is number 71, and this week on the podcast, I needed to go on a little bit of a rant about Robinhood. Robinhood is a brokerage firm, investment platform that's really popular with typically younger and maybe more novice investors and traders around the country, partially because they have no account minimums and no commissions, which is really a great option when you're just starting out funding the accounts for the first time and are trying to minimize your expenses and potentially taxes, which I would argue most investors should be cognizant of and attempt to do. The downside is that there are a lot of things going on the back end of how Robinhood operates that basically sets up a lot of novice investors to fail. And it's my personal opinion that Robinhood needs a little bit more oversight. And in this week's episode, I cover how the brokerage firm is set up, how they make money, why that's not always in the best interests of their own clients, and what you should know if you have an account at Robinhood. I hope you enjoy it. All right, so Robinhood has been on my mind quite a bit over the last, 12, 18 months, something like that. Robinhood, I believe they launched in 2014, 2015, something like that. So they've been around for quite a while, and it's definitely an innovative company. It's somewhat disruptive in that it was the first brokerage platform to offer $0 account minimums. Well, no account minimums, I guess is a better way to put it, alongside commission-free trading. So you can trade all the stocks, ETFs that you want, free of commissions. And that was a pretty attractive thing because that didn't used to exist prior to Robinhood entering the industry. And then what you saw since they started offering that is it was competitive pressure to where other brokerages basically had to follow suit, and then Schwab dropped commissions to 0, which was an interesting choice for them. I don't know that they were getting too much pressure from Robinhood to do so, but the industry was moving in that direction. And Schwab was better able to sustain the lost revenue by dropping commission dollars to 0 than its primary competitors. Not Robinhood, but TD Ameritrade. And so there was this move by Schwab a couple of years ago to reduce trading commissions to 0, knowing that TD Ameritrade would have to follow suit to remain competitive and that it would be more harmful to TD Ameritrade than it would be to Schwab. Come to find out, a couple months later, Schwab made an offer and eventually purchased and acquired TD Ameritrade. So it was a pretty savage strategic move by Schwab to follow suit. But this whole trend toward working commission rates down to 0 in the brokerage industry was really initiated by Robinhood. And so since Robinhood has entered the industry, and again, it's been, I guess, 7 years or so now, 6-7 years, they've grown by a lot. They are really popular with younger investors because of the lower costs and so forth. But there are a lot of problems from my perspective that we ought to know about as investors that are not very well disclosed. And just simply the way that the brokerage firm is set up is really meant to lead people and lead investors on that platform toward an undesirable outcome. And there are a number of examples of this. So this has been on my mind for a while. As I say, the last 12 or 18 months, because Robinhood's been in the news a lot. They were right in the middle of that whole GameStop debacle here a few months ago. But I was triggered to record this week's episode and focus on Robinhood because there's been a story circulating in my professional networks of financial planners of some poor person was day trading all year last year on Robinhood, and they did okay. Apparently, they were I don't know what the size of their account was. Maybe it was like $100,000, but on the year, I think they were up like $40,000. But because they were day trading so frequently, and because they didn't understand the rules surrounding wash sales, which I'll explain in a moment, they had a cash gain of around $40,000, but a 1099 was issued to them for like 1.3 million or 1.4 million. So you come up to the end of the year with 40,000 extra dollars in your account, which is great, but now you have taxable income of 1.4 million added to your tax return for the year that you owe the IRS and your state just because you're engaging in these frequent sales. And so the way that can happen, well, let me back up. So this is just a horror story of a day trader out there who didn't understand the tax ramifications of what they were doing, and a large part of that is because of how Robinhood is set up. It's set up to, drive revenue for the brokerage firm very, very often at the direct expense of its own clients, its own customers. So you're probably wondering, well, how can they only come out with $40,000 of cash yet owe this big massive tax bill? Well, the way that this works is if you're day trading frequently, I'll use an example here. Let's call it Apple, is because it's easy and everybody knows about it. Let's say Apple is trading at $100. You buy it. You buy one share for $100. Remember, you're not paying any commissions for this, so you have 100 shares, or sorry, one share in exchange for $100 in your brokerage account at Robinhood. And let's say it goes up by $1. Now it's worth $101, and then you sell it later on in the day. So you've just made $1, right? And if you didn't have any other transactions for the entire year, then you would have a 1099 issued to you and have $1 of short-term capital gains that you have to pay tax on at the end of the year. And again, we've covered this on the podcast in the past, but short-term capital gains are investment gains on any security, any investment that you've held for 1 year or less. As soon as you hold an investment for 366 days, long-term capital gains treatment is triggered, which is preferential. You're taxed at your ordinary income rate for short-term capital gains, but long-term capital gains rates are lower, which is really convenient. And for people that have sizable gains in certain positions, oftentimes you want to try to hang on to that until at least day 366, so you pay far less tax on your gain. So if you buy a share of Apple for $100, it goes up and you sell it, you have $1 of short-term capital gains that you owe tax on. Now, what happens if it goes down? So let's say that you buy a share for $100, it goes up to 101, and you sell it. Now you have $1 of short-term capital gains. Then let's say the following day, you take your cash. Let's say you take $100 because the share price of Apple has fallen from 101 back down to 100. So the following day you wake up, Apple's trading at $100 again, and you buy it. You buy one share. Now you have one share of Apple and $1 left in your account that you didn't use. What happens next is the share price falls by $1, and then you sell it at $99. Well, now you have $1 of short-term capital gain from the first transaction and $1 of short-term capital loss from the second transaction. And so from a tax perspective, those two trades offset. And the result is a net of $0 of short-term capital gains. So you owe no tax on that. You offset your dollar of gain with your dollar of loss. Now, let's say that the third day, you want to buy Apple again. Let's say that it bounces in the after hours market. Day number 3, it's trading at $100 again, and you buy it back for $100. Well, this is what triggers these wash sale rules. You cannot claim a capital loss unless you're out of the position entirely for 30 days. So by purchasing it back on day 3, you void the capital loss that you thought was offsetting the gain on day 2. And this is what happened to this trader. They were in and out of different securities really, really frequently, thinking that they were capturing losses to offset the gains. And lo and behold, they ended up at the end of the year with $40,000 of extra cash. And the numbers are probably a little bit off, but the point is, they were up a little bit on the year, but triggered this massive tax bill because they didn't understand that they had to be out of these positions for 30 days so that the wash sale limitations were not triggered. So that's one symptom of the problem. And the problem being that Robinhood is not set up in a way that's conducive to positive investment outcomes. And I'll go over why that is here in a few minutes. But that's one issue. Another issue and another example of this, which is, and I mentioned this on the podcast a while back, this is probably the worst case scenario I can even come up with. It was probably about a year ago, maybe a year and a half ago, there was some young trader getting in there, trading a bunch of investment products that they were not familiar with and racking up a lot of losses. And this young person was like 17 years old or something like that. They put some money into the account. The losses kept piling up. They lost more than the cash that they had in the account, which is possible when you're trading options and going on margin and so forth. And at one point, he logged into his account and saw a negative balance of $730,000. And so, thinking that there was no possible way out of this, that he could never dig his way out of this debt, he ended up dying by suicide, which is the worst possible thing. It's a horrifying story, and I believe that there's been federal inquiries, and the CEO of Robinhood has been called in front of Congress multiple times, and I'm sure that this is something that they've asked about. But that's another symptom of the problem, and the problem is that this trading platform is not set up to help people. It incentivizes short-term trading. There's very little support or guidance on the ramifications surrounding the ramifications of what they're doing. And the way that the brokerage firm makes money is at the direct expense of its own clients. So here's 2 examples of why it's such a crummy platform for most investors. Let's cover for a few minutes why or how the platform makes money and why it's set up that way. So brokerage firms make money in a number of different ways. And historically, and we talked about commissions a few minutes ago, historically, a broker would be an investor's access to a certain market. And so you open an account somewhere, you buy and sell stocks, you buy and sell bonds, mutual funds, whatever it is. Your broker is the one that executes the trade for you. You give them the money, they go out and buy the shares on your behalf through ordinarily maybe one or more different intermediaries. So they act as a broker and they charge you a commission for that service. That's one way that brokerage firms historically have made money. Another way, which is the primary way I would say brokerage firms make money today, is through net interest margin. Net interest margin is just like having cash in a bank account. When you have cash in a bank account, the bank doesn't have 100% of its clients' deposits in the vault at all times. If the bank has $10 million of deposits, they're taking a pretty substantial portion of that $10 million and they're lending it out at a higher interest rate. And the bank makes money on the margin, the difference between the interest rate at which they lend and the interest rate that they pay on your deposits and mine. And because of the level that reserve requirements are set, banks have no obligation to have 100% of the deposits on hand. They're free to do other things with it. Brokerage firms operate in the exact same way. And so back to our one share of Apple example, if you put $100 in the account, you buy a share of Apple and then you sell it at 101, that extra dollar that's in the that's in the account, if you're using the $100 to reinvest elsewhere, that might just sit in the account. And so, just like a bank, the brokerage firm doesn't have an obligation to keep that dollar or any of the cash that sits in your account, for that matter, in the vault on hand at all times. And what most brokerage firms will do, Schwab does this. Most large brokerage firms these days will set up an affiliated bank and have some kind of quote unquote cash sweep program, because the cash that sits in your brokerage account, your broker is allowed to reinvest and lend out at a higher interest rate, but there are a lot of limitations surrounding what they can invest in. But if they sweep that cash over to the bank, that's an affiliated third party maybe, the bank has a lot more discretion in as far as what they do with it. So if the net interest margin, and I'm just pulling this totally out of thin air, I don't know what the margins are these days. If the net interest margin under a brokerage firm is maybe 1% between what the broker might earn by reinvesting the cash in your account or lending it out elsewhere, the spread by sweeping it over to their bank might be like 3 or 4%. So it's really in the brokerage firm's best interest to manage cash in their clients' accounts thoughtfully, not taking too much risk, of course, and there are all these federal limitations surrounding what you can do with it. But it's an opportunity for the brokerage firm to make money, and lo and behold, that's exactly what they do, right? So brokerage firms, historically, they make money from commission dollars. They make money from net interest margin. There are also some other things going on the back end where they'll make money. Securities lending is a pretty large component these days of brokerage firm total revenue, and oftentimes it'll be wrapped into net interest margin, I believe. Securities lending is something that I'm really familiar with because I spent the first 7 years of my career on a securities lending trading desk. But basically, when you go on margin in your brokerage account, let's say you have $10,000 in a margin account and you use that $10,000 to buy $14,000 worth of stock. Well, you have a margin balance. And the collateral for that margin loan that the brokerage firm has extended to you are the securities in your account that you've decided to purchase. So by virtue of having some discretion over that collateral, which is inherent in the margin agreement that you signed to open the account in the first place, the brokerage firm can quote unquote hypothecate 140% of any margin balance in your account. Hypothecate means that they can take the shares out of your account and lend them to another broker or to another one of their clients for the purpose of short selling. It's not a nefarious thing. It's just how it works. It's that right to hypothecate your securities is in exchange for the margin that they're extending you. And so brokerage firms do this all the time. There are also fully paid lending programs where your broker, if you do not have a margin balance, but you have a share of stock that your broker wants to borrow from you, they might approach you and ask for your permission to borrow it from you in exchange for a cut of the money that they'll make by lending it out to another party. So securities lending is these days pretty large driver of how brokerage firms make money. It's not hugely substantial. It's not more than a quarter of total revenue, and it's probably less than that, I would say. But it's definitely a larger portion than I think a lot of people realize. So you have commissions, you have net interest margin, you have securities lending. The source of revenue that started to get Robinhood in trouble, or at least maybe some more scrutiny recently, is a practice called payment for order flow. And all the large brokers, I believe, do this to some degree, but Robinhood has done it in a more blatant way than I believe all the other brokerage firms operate. So payment for order flow means that when you open an account at Robinhood or any other broker and you want to buy those shares of Apple or IBM or whatever security you want to invest in, you're giving money to the broker and asking them to execute a transaction on your behalf. And if Robinhood has another trader who owns 100 or one share of Apple or whatever the quantity is that you want to buy, they might offset your trade with theirs and clear it without having to go out to the exchange or transact with another broker or clearing firm. But what ends up happening is if you have a bunch of accounts at your brokerage firm who are buying Apple and a bunch of accounts that are selling, you're not able to, you don't have the exact same number of shares that are being bought and sold at the same time. There's always some difference. And so if the net amount of shares of Apple that you as the broker need to purchase is, say, 50,000, because you have your clients buying 50,000 more shares of Apple than your selling clients want to sell at that time, then you have to go out into the market. And when you go out into the market, you can go to another brokerage firm. You can go to a firm that has a seat on the exchange. There are a number of places where you can send that order to buy 50,000 shares of Apple. Robinhood sends the vast majority of its trades to a company called Citadel. Citadel is a big hedge fund, and they do a lot of high frequency trading. And my understanding is that Citadel doesn't have an obligation to clear all of Robinhood's trades, but it has kind of right of first refusal. And so you have these really sophisticated high frequency traders just basically picking off Robinhood investors left and right because they have the opportunity to buy or sell on the other side of Robinhood's clients' transactions before anybody else in the market. I'm not totally certain exactly how it's set up, to be honest, but I do know that Robinhood makes an absolute killing by directing their trades to Citadel and maybe a couple other operators. You would think that you would want a totally competitive environment where if you're trying to buy shares or sell shares of a security, your order is sent out there into the market where in a competitive environment, you have other buyers and other sellers competing for your order. Because when you have more competition, that's going to work to your advantage. You're going to get better execution and better pricing on your trades. But it appears to me that Robinhood is directing all their trading traffic to one or maybe a couple different parties, and that competition is not present. And in exchange for that direction of order flow, and this idea is called payment for order flow. And in exchange for that trade flow, Robinhood gets paid directly. They get cash in the bank revenue directly from the parties they're directing their trade flow to. So it doesn't work to the advantage of their own investors. Now, I used the term a minute or two ago, picked off. If you're someone who is opening a Roth IRA for the first time, you put $5,000 in it and you're buying a share of Apple, picked off means that you might have to pay a penny more for the share of Apple you're buying than somebody routing their trades in a more competitive way. So the outcome here is not going to be drastic. It's not going to be sizable to most investors. Institutions and really large investors will want to control their own order flow because when you're buying 1 million shares of Apple at a time, 1 penny in execution makes a much larger difference. When you're buying a couple shares at a time, it really is somewhat negligible. But it still matters. And when you direct all your customers' trades to one party or a very limited number of parties in exchange for cash, it just ends up being, it just strikes me as another way that Robinhood is sitting directly in between their own clients and a desirable investment outcome. So that's how Robinhood makes money. They're not charging commissions, right? They entered the industry and attracted a lot of attention and investment dollars and interest initially because they do not charge people commissions. They make a lot of money on securities lending. They make money on net interest margin, and I believe that the if it's not the biggest source of their revenue, it's pretty darn close to it. But a huge driver of the revenue is this payment for order flow that they're sending mostly to Citadel, and that's a problem. So those are the drivers. Think of this too. So when, for example, in our financial planning firm, our investment philosophy is to be long-term and consistent. We don't want to trade any more frequently than we need to. When our clients' portfolios fall out of balance, when they have money coming in, money going out, we need to place trades to make sure that their portfolio is structured in the correct way. But we don't want to trade unnecessarily either. From Robinhood's perspective, because so much of their revenue is driven by this payment for order flow, more trades mean more revenue and more money to the broker. If you have one investor that wants to buy that share of Apple and hang on to it, they're going to get paid for one trade, that one purchase on the way into their position. But if you have a day trader who's buying and selling in and out, in and out, in and out, like this person who racked up $1.4 million in 1099 gains last year that I was talking about, well, you get paid every time that they transact. And so Robinhood is directly incentivized to try to get their clients to trade more. And lo and behold, that's exactly what they've done. I've not been on their platform, but I've read quite a bit about it. Every time you transact a trade, there are like images of balloons that fall from the top of your screen. There's confetti that goes off. And they use all sorts of subliminal, if I could pronounce that right, strategies to try to get their own customers to trade more. And we know, based on the empirical evidence and the study that's gone into this, that there's a very strong correlation between trading more and reaching a less desirable outcome. So in other words, in general, the more you trade, the worse off that you do in terms of investment returns long term. Yet Robinhood makes money by the exact opposite of that. And so they've built this app and this platform that tries to trigger people to trade more, because more trades means more money for them. Now, it's not a clear-cut absolute that the more you trade, the worse off you do. I'm sure everybody listening to this has a cousin or an acquaintance at work who's day traded their accounts and claims to do really well. And there are, if we were sitting here with Robinhood's CEO, they would argue that it's not their role to provide investment guidance or advice. Their role is to provide access to the markets, and people who have a right to trade any way they want. And that's absolutely true. I completely agree with that. But when you're setting up people who are often less sophisticated, novice investors, which is clear that that's their target demographic, and you're incentivizing them to trade, even when it's not your maybe responsibility to govern how they're trading, when you're set up in a way where your interests are directly in conflict with the interests of your clients, that's a problem. And this case with the $1.4 million 1099 is a symptom of that problem. This issue with the young options trader taking his own life is a symptom of that problem. And as much as I believe that free markets are the most efficient way to allocate resources, and we should allow companies in the free markets to decide pricing and this capitalistic structure we have is such a wonderful way to drive an economy. This is one area where I think this brokerage firm specifically, and probably others, need a little bit more regulatory oversight. So that's what I'm seeing with regard to what Robinhood has going on and how it's set up and why it's not in their best interests. If you have an account at Robinhood, there's nothing wrong with that. I would suggest that you have some kind of plan and strategy with regard to what you're doing with your investments. A lot of our clients they really like to have a little bit of play money that they're buying and selling individual securities in, and they understand the risk, and it's not a very substantial portion of their aggregate portfolio. It's just kind of a play account that they dink around with, and that's fine. But with this in mind, I think we need everybody here should understand that the path to the best investment outcome is a consistently employed long-term strategy that focuses on diversification and an appropriate amount of risk based on what you're trying to do, where you're at in your life, how much risk you're comfortable with. Those are basics. I probably sound redundant when I say things like that. And if you want to have an account at Robinhood, you can build a portfolio with $0 in commission costs that accomplishes just that. But just know that they're going to probably send you push messages to your phone and do things that'll probably not be in your best interest long term. So, you can definitely have a consistent core portfolio there. And you can also have a play day trading account there too. But I think we need to separate the noise and from what actually works, because there's a lot of academic evidence and empirical evidence and academic support that is to the long-term consistent strategy. That's what's going to lead you to the best outcome. Before we adjourn for the week here, Robinhood's not the only broker that makes money on payment for order flow. I don't know exactly how they're all set up, to be totally honest, but I believe that all the brokers have some kind of arrangement. And my understanding is that Robinhood's is simply the most blatant. And on one end of the spectrum, you have a totally open free market where you have buyers and sellers bidding against each other, which really lends or produces a lot of price discovery. When you have a lot of people trying to buy the same thing at the same time, it'll drive the price up a little bit. When you have buyers and sellers all interacting and transacting in a centralized place, that's what's going to aid price discovery. When you route orders to one party and one party only, you're not going to get optimal execution on your trades. So there is some elements of that in pretty much all the brokerage firms. I just don't know what the extent is, and it's not as aggressive as Robinhood's, because other brokerage firms make more on some of those other areas. Securities lending, net interest margin, all the other stuff that we talked about. Okay, thanks for bearing with me. This week was a little bit of a rant, but it was something that I think we needed to talk about, something that I've wanted to address on the podcast for a while. All right, that's it for me. Have a great week. Talk to you soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.